Hi there, welcome to Kneppy Invests. Time for another group video of companies that did achieve an operational cash flow positive June quarter. This would be about the fifth or sixth group video I've done, and about 7 more to do after this one. And a diverse group of companies I'll be looking at in this video, which include a gold mining company, a pearl company, a printing company, and an energy company. So let's have a look at the first company, which is that pearl company. And that pearl company is, naturally enough, Atlas Pearls. They produce and distribute white and silver South Sea pearls. Now, I know nothing about pearls. I don't know if South Sea pearls are some sort of exclusive pearls or better quality pearls than other pearls. I just don't know. So I'd have to do a little bit more research on pearls if I wanted to invest in this company. But the numbers look pretty good. They harvested 560,000 pearls in the financial year, and their nucleated oyster stocks grew by 40% to $1.3 million in the past year. Now, I'm assuming that nucleated oysters are just those oysters that produce pearls. I have no idea. They have operations in Indonesia. And when I look at the value of this company, so the market cap of Atlas Pearls is 10 million at 2.6 cents, and the enterprise value is 11.2 million because they have net debt of 1.2 million. It does look like there is potential value here when you compare the valuation to the fact they have cash receipts in financial year 21 of 18.2 million, and the operating cash flow was at 3.8 million for the year. And if we turn our attention to the June quarter, they received $8.3 million in receipts for the quarter and were operational cash flow positive in the one quarter by $4.3 million. Now, I don't know a lot about pearl producing and harvesting, so there might be a harvesting season, and maybe we're just come out of the harvesting season. And I don't know if the harvesting season aligns with when they sell the pearls. Maybe they sell all their pearls in the one block, or maybe it's a few blocks during a year. So there's a lot more research I'd have to do for me to invest in this company for the long term. But there is some attractiveness just because of the valuation right now. The other thing that does attract me to Atlas Pearls is when you look at the receipts history, and even though we only have 6 quarters of history, I would prefer at least 8, we do see receipts growing through this period. And the start of this period was actually the March quarter 2020. So that's around COVID-19. Not sure if the pandemic hurt their operations in Indonesia, maybe during some of these quarters. I'm not sure if the dip in the receipts in some of these quarters is just because they sell their blocks of pearls or their pearls at different times of the year. And more than likely, that's why we did see a really good quarter in June, because $8.3 million of receipts is quite a bit higher than what we've seen over the past 6 quarters. So maybe you just got to keep that in mind if you are thinking about buying into this company. Don't get too excited about their June quarter results, because we might see receipts and the operating cash flow pull back in the September quarter. As we look at the weekly chart for Atlas Pearls going back to 2016, we see a long period of time here between the start of this period to around the COVID-19 financial panic, when the market was not interested in this company at all. In fact, the interest waned throughout this period, and we saw the share price drop from about 5 cents to a low of 0.5 cents in May, June of last year. But the sentiment in this company has shifted to positive. We actually have seen a share price rise from that low of 0.5 cents to a current share price of 2.5 cents. So share price has increased by 5-fold over this period. And when they did release their June quarter results on the 30th of July or 31st of July, the share price actually rose 50%. So the market loved their quarterly results, and we saw a massive increase in volume, not only on that day, but also the next day as well. And that's actually a good sign. We're starting to see the market becoming interested in this company, and that interest is driving the share price higher. Second company I want to look at is Rand Mining, ticker code RND. This is a gold producer. They do have actually a joint venture with another mining company that I'll be looking at in my next group video, which is called Tribune Resources. I think they have a 25% stake or something like that. Ticker code for this company is RND. Market cap, $82 million at $1.46. Cash receipts for the financial year, $43.2 million. They were operational cash flow positive for the year at just under $10 million and finished the June quarter, with $1.4 million of cash. Now, they did do a share buyback and they spent $4.9 million of buying back shares. One of the interesting things about this company is something that affected one of their mines on the 14th of January 2020. And when we look at their financial history, we'll be able to see the impact of this event on the company's finances. This is Rand Mining's financial history, looking at revenue and cash flow from operations from 2012 to 2020. Now, we don't have the revenues for financial year 21 just yet. They haven't released that, but we do know their receipts were that 40 odd million, and they were operational cash flow positive. So we can actually see the revenue and cash flow from operations rise between 2012 and 2019. Revenues rose from 15 million to 79 million. And operating cash flow rose from 3 million to 47.7 million. Then we see a dramatic drop-off in 2020. And that was because the mine production at one of their mines was severely affected by a large seismic event on the 14th of January 2020. In fact, mining was suspended in that mine in April 2020 and put into care and maintenance. That's why we saw a massive drop-off in revenue that year, and they were operational cash flow negative by $41 million. The other thing I haven't mentioned just yet is when you look at the inventories in the half yearly that was released in February, they had $66 million of inventory. So that's gold stockpiles. So even though they have a market cap of about 80 odd million, they don't have a lot of cash. They have a lot of inventory, a lot of gold or bullion stockpiled. So the enterprise value, or the true value of this company, is in the $20 million range. And that's why this company might be a little bit attractive for those who are seeking out some value. When we look at the weekly chart for Rand Mining, it does look almost interesting because the share price right now is right on a support level at around $1.40, $1.45. We've seen this price level hit about 4 times in the past, once in 2016, once in 2018, once in 2019, once in 2020, and each of the times it hits this price level, the share price has bounced off it. But we are in a nice little downtrend right now, although the share price has sort of gone sideways over the past 6 months or so. So right now, fairly interesting with Rand Mining. We had that difficult year for the financial year 20 with the closing of that one mine. But things have progressed nicely. They're still operational cash flow positive. They have a lot of stockpile. So this could be an attractive value play for those who maybe do a little bit more research on this company. So I'm not fully across this company completely. So there's still a lot of questions I have in regards to Rand Mining. Third company I want to touch upon in this video is Energy World with the ticker code EWC. They produce and sell power and natural gas in the Australia Pacific region, in particular Philippines, Indonesia, and Australia. Their assets include power plants, LNG plants, and gas fields. Market cap of Energy World is $193 million at 7.4 cents. However, they have $635 million of debt. That means the enterprise value is more like $800 million. So you can't look at the market cap and judge the value of this company. You have to look at the enterprise value because of the debt. So some investors might make that mistake because Energy World have receipts of $154 million for the financial year and were operational cash flow positive by $25 million, and they have $15.5 million of cash. So if you look at the valuation and just focus on the market cap, you might be thinking there's some good value here, but you do not taking into account they have a significant amount of debt. And when we look at the June quarter results for Energy World, even though they had receipts from customers of $41.3 million, they were only operational cash flow positive by $490,000. That is ringing some alarm bells just yet now, but that could be low for a reason, and some reason I just don't know. But when you look at the interests and other costs of finance paid during the quarter, they spent $15.3 million of interest. And that's quite a bit higher than the year to date. So maybe they spent a lot of money on interest during the quarter. For some reason, that really did pull back their operating cash flow. So you can just see when a company is in debt, it can hamper the operational cash flow. When I look at the financial history of Energy World, this is focusing again on revenue and operating cash flow for a period between 2012 and the most recent financial year, 2021. Nothing to get too excited. There's no growth in revenue. Growth is almost running flat. Maybe it's increasing at a very slight rate, but over the past 5 or 6 years, revenue has actually gone backward, and the operating cash flow is really just going sideways. In fact, the operating cash flow for financial year 21 was lower than financial year 12. So nothing to get too excited with Energy World. When you look at their financial history, no growth at all, or very little growth in their revenue and operating cash flow. And to be honest, the market is not that interested in Energy World at all. When you look at their weekly chart going back to 2015-16, share price high during this period was way back in 2017 when the share price got to around 45 cents. And then we saw the share price move into a long-term downtrend from the start of 2018 at around 30 cents, and the low was reached around the COVID-19 financial panic, and just after that in September when the share price got as low as 5 cents. But the long-term downtrend has come to a completion, and we have seen the share price move sideways over the past few years. We did see a couple of moments in the beginning of this year where we did see a rapid rise in share price in 1 week, and then we just saw the share price pull back in the following week. So sort of a false breakout in the share price on those 2 occasions. And we know it's a false breakout, or we can surmise it's a false breakout in hindsight because the share price has pulled back, but also because when the share price did rise quite highly on those 2 weeks, there was not a lot of volume, so there was not a lot of interest in the market with those rises. You want to see high volume whenever the share price rises like that in 1 week or 1 day. And ever since that last rise back in May of this year or April, the share price has been drifting downwards and is currently at 7.4 cents. The last company I want to touch upon is maybe one of the lowest quality companies on the ASX, and that is Ovato. Their primary business is printing, which is, funny enough, that was my parents' business. They were the owners and operators of a printing business. And I would say you need to be good managers, good owners for a printing business to succeed. It's not a very profitable sort of business, and Ovato has shown that when you look at some of their finances. Cash receipts of $839 million for the financial year. And you just think, if a company is receiving $839 million in cash receipts, they must be profitable, they must be operational cash flow positive, or the margins are really low. And unfortunately for Ovato, they were actually operational cash flow negative for the financial year by $4.8 million, even though they received $23.2 million in government grants and tax incentives. And maybe that's why they went through some sort of restructure, and they did sell off some of their divisions, and now they're focusing on their printing business, which may be a good move because maybe some of those other divisions they've sold were doing them harm, not good. They do have $17 million of cash, but $55.5 million of debt. And that debt number would completely scare me off. And I think it has scared the market off, because if we look at the chart over the past 4 years, we just see a massive downtrend during that time period. And the share price right now at 0.2 cents is an all-time low for this company. When we look at the financial history of Ovato, looking at their revenue, which is a little bit different than the receipts, you might notice that their revenue for financial year 21 was only $443 million, but their receipts was over $800 million. Not sure exactly why there's a massive discrepancy between the two, but I did verify those numbers looking at that financial report. There is a big difference between their receipts and revenue. There is a reason behind it, but I don't want to go to too much depth because I really don't want to do much research on this company. But when you do look at the revenue, over the past 7 years, it is going backwards. This is exactly the opposite what you want to see in a company you own. In fact, revenue have dropped from $900 million in 2014 to $443 million in financial year 21, and the company was operational cash flow positive back in 2014 through to 2016, but that's gone backwards as well. In fact, back then, they were operational cash flow positive by about 30 to 35 million. Now they are operational cash flow negative. So financial state of this company is not looking attractive at all. I'm not sure why you would want to take a position in this company when you look at these sort of charts and the fact that they have a fair bit of debt, $55 million of debt. Everything's just going down, including the share price. So let's have a look at the chart right now, and we're going to see how the share price has gone off a cliff over the past 4 years. This is the weekly chart for Ovato going back to 2017 to current times. I've already mentioned the share price has fallen off a cliff, and it really fell off a cliff towards the end of or later period of 2017 when the share price went from about 30 cents to 20 cents in 1 week. So more than likely that was some bad results, some bad news from the company. And that was the beginning of a downtrend. And we've just seen the share price just continually get lower and lower and lower. And is currently at 0.2 cents, the all-time low for this company. Maybe the restructure they have been doing and focusing on their printing business will be a success, but I would prefer to wait for evidence that is a success before even thinking about jumping into purchasing some shares in this company. That is all I have for this June quarterly report for these 4 companies that were operational cash flow positive for the June quarter. If you do have any questions about any of these companies or any other company on the ASX, leave your questions, your thoughts, your opinions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out an advisor who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.